So hello and welcome, everyone. Thank you for tuning into my presentation. As Casper said, my name is Martin Eriksson, and I am an investment manager at Viking Venture. Today's presentation will include a short introduction of Viking Venture, so who we are and what we do. But the main part of the presentation will be about the current state of SaaS in the Nordics and how we at Viking Venture value companies. The presentation will last for around 20 minutes, and then there will be some time at the end for Q&A. So if you have any questions, make sure to jot them down, and I'll do my best to answer at the end of the presentation. So Viking Venture, what do? We help Nordic software companies scale, and that's all we do. And this focused approach, it means that we have a lot of experience working with Nordic SaaS companies in every stage of their growth journeys. We are the leading Nordic B2B SaaS investor in the Nordics, and hopefully today's presentation will give you an understanding as to why we believe this to be true. I think we can start with a little bit of information about us. So if we look at the top left of the slide, what type of companies do we invest in? We invest in Nordic B2B software companies who have reached an ARR of 3 million euros or more. The companies, they don't need to have high growth rates at the time of investment. However, we need to see a large potential for growth going forward. Now, typically, these companies will be the market leader in their home market and perhaps have business in a few other Nordic countries or maybe a few other European countries and are now looking to scale internationally. Lastly, and maybe the most important investment criteria that we have is they need to have software which supports work processes. So said a little bit differently, the solutions are need to have rather than nice to have for their customers. That means that products are very sticky. Typically, they have low churn rates, which allows us to utilize the Viking Venture toolkit, which is something I'll come back to in a little bit. We are typically an active minority investor. However, we also do majority deals on occasion. It all depends on what the situation in the company is. We look to do a mix of primaries and secondaries when we invest. And the reason for this is that we believe that management and founders who've been able to take some chips off the table and reduce their risk make better decisions for the companies in the long run. Lastly, we consider ourselves to be very founder friendly, which I think is something most investors would. But I think the way that we sort of prove this is that we don't use any different share classes. We typically stay away from any types of preference structures, which means that once we're on board as an investor, we are all sitting on the same side of the table, which I think says something about the way that we like to work with our portfolio companies. So our portfolio today, it consists of 17 Nordic B2B SaaS companies spread across the Nordics, mostly private companies, but also some listed. And since the focus here is on Denmark, these are the Danish companies in the portfolio currently. We have 5, ranging from 4 to 10 million euros in size. So a good base of Danish companies, but we're always looking to add new and exciting companies to our portfolio. So if you think your company and Viking Venture are a good match, then make sure to get in contact after this presentation. So we're an active investor. What does that actually mean? It means that we like to be deeply involved in all of our companies. And this slide, it summarizes the main tools in our toolkit. So within Viking Venture, we have 2 teams. We have the operational excellence team who work with the top row. And then we have the investments team who work with the bottom row. And the operational excellence team, they work like any management consulting team would on a project basis. And the investments team will work with the companies from investment all the way to an eventual exit. And if you speak to any of our portfolio companies, they are likely to highlight business models and pricing as one of Viking Venture's key strengths. But we also do a lot of work with strategy, scaling sales and customer success, building complete management teams, KPIs, M&A, and financing and exits, of course. So a key differentiator we have is the community that we've been able to create within our portfolio. We don't invest in competing solutions, meaning there's a high degree of trust and openness in the community. No one's looking to sell you anything. It's all about sharing best practice within the portfolio. And to be a little bit more concrete in terms of what we actually do in the community, we group all employees within the portfolio into different roles and arrange for at least 2 best practice sessions every year. We also have the leadership program for the brightest talents within the portfolio. We have a CFO Academy, a KPI dashboard, and a community portal, which is basically a knowledge bank, which is populated by the portfolio companies themselves. So a lot of fancy words, but what do you actually have to show for it? I think this graph is a good illustration of what we in the portfolio have been able to achieve. What we're looking at here is the total growth in ARR within our portfolio since 2017. The dark blue is the level of ARR at the time of investment. Green is what's come from organic growth, and light blue is what's come from M&A. So on average, our portfolio companies have grown by 42% a year, split pretty evenly between organic and inorganic growth. And this ties quite nicely into the previous slide on the Viking Venture toolkit. So organic growth obviously comes from adjusting business models. It comes from pricing. It comes from scaling new sales and customer success, while inorganic growth comes from M&A. And as I'm sure we're all well aware of, growth is the biggest driver to valuations within SaaS. So these are some numbers that we're pretty proud of. So that concludes the section on Viking Venture in our portfolio. Next, I want to talk a little bit about what has happened in the market in the last 2 years or so, the most important SaaS KPIs as seen from our perspective, and how these two things affect valuations. We value B2B SaaS companies based on multiples by combining market sentiment and company-specific KPIs. Market sentiment gives us our starting point in the form of an EV/ARR multiple. Then we compare a selection of the most important KPIs of the relevant company to benchmarks and attribute either a markup or a discount based on performance, which gives us a final EV/ARR multiple. So let's start with the first input, which is the market. There is no doubt that the market has a big effect on valuations. So what has happened in the last 18 or 24 months, and where are we today? As we can see from this graph, inflation has skyrocketed since 2020. I'm sure most of you have increased your prices recently, and you've probably received a few notices of price increases as well. We can see from the graph that inflation has decreased somewhat from its peak, but I think it's pretty safe to say that inflation is still pretty high. So high inflation, what else? What else do we have? Well, we can see from this graph that labor markets are strong. At the start of COVID, we saw a pretty sharp increase in unemployment rates. But as we all adjusted to the new normal and unemployment rates quickly decreased, right now we're experiencing an extremely strong labor market, probably too strong given the current economic climate. So we have high inflation rates and low unemployment. What can central banks do to remedy this? Well, they can increase interest rates, which they definitely have done. And as we can see from this graph, the Fed has increased interest rates to 5.25% in an attempt to cool down the economy. And the result of high inflation, low unemployment rates, and high interest rates means future cash flows are not worth as much as they once were. And as we know, companies are valued on their future cash flows. So this has resulted in valuations taking a dip. What we see here is the Viking Venture Nordic SaaS Index. It's a comparison of listed Nordic SaaS companies to the BVP Cloud Index. And we publish this every week, so if you'd like to subscribe, you can do so via our website. And for those who don't know, the BVP Cloud Index is Bessemer Venture Partners Index, which includes the world's best cloud companies and what we consider to be the best indication of where the market for B2B SaaS is. And as we can see from the two graphs, the BVP Cloud Index and the Viking Venture Nordic SaaS Index, they follow each other quite closely. The most interesting part of this slide, at least to me, is the table which we show at the bottom right. We can see the development in the median EV sales multiples for the Viking Venture Nordic SaaS Index, the BVP Cloud Index, and the individual Nordic countries. So right now, the medians are 2.9x and 6.5x, which is down from 10 and 15.8x 2 years ago. So a pretty significant fall in valuations. It's also pretty interesting to see the variance when looking at the different Nordic countries, where right now Norway is much lower than its peers. Now, when we value companies, we use the median from the BVP Cloud Index as our starting point. And the reason that we use this and not any of the other Nordic countries is because we don't have the same level of maturity in the Nordics when it comes to listed SaaS companies that they have in the US especially. So now that we've covered the first input, let's have a look at the second input, which is SaaS KPIs. This is the Viking Venture KPI dashboard. This is a selection of the most important SaaS KPIs split into 3 groups. We have growth and profitability. We have customer acquisition costs and sales efficiency. and we have coverage model and sales process. This is a tool that we use towards all of our portfolio companies. So every month, each portfolio company reports their numbers into a central repository, which forms the basis for these calculations. This dashboard allows us to track the performance of our portfolio companies and quickly identify any areas which need improvement. So twice a year, Viking has an internal strategy session where we grade each KPI for each company on a scale of overperforming, performing well, or underperforming. And this gives us a helicopter view of the relevant company, and it allows us to quickly, as a team, decide where we need to focus in the next 6 months in order to increase valuations. And a number of these KPIs, they also form the basis for our valuation scorecard. So the KPIs marked in red here are the ones which are directly included in the scorecard. Total ARR, that tells us the overall size of the company. The bigger the company, the less risk associated with it. ARR organic growth rate is, of course, the number one driver to higher valuations within B2B SaaS. We all know this. Then we have the EBITDA margin, this being EBITDA minus CapEx, which is basically capitalized R&D. So EBITDA is a standardized metric across markets, and capitalized R&D is pretty easy to extract. So this is our way of getting to a quick and dirty proxy for cash, which tells us something about profitability. And just a quick point of reflection on that point before we move on. We have recently gone from a growth at all costs mentality within B2B SaaS, where growth was valued at 6 times more than profitability, to then seeing a sharp shift in the market towards profitability. Investor sentiment changed, and suddenly growth and profitability were valued at exactly the same. Now, more recently, we've actually seen a comeback for growth, and currently growth is valued around twice as much as profitability. Next, we have the SaaS gross margin, and this is a fully loaded gross margin, which includes all costs attributed to the delivery of your product in its current state. This is much different to the gross margin on most P&Ls, which will only include hosting costs. We're seeing increased focus on profitability, and because of the many different delivery models and constellations of ARR within B2B SaaS in recent years, the idea that B2B SaaS companies are inherently profitable is no longer as true as it once was. That means that the SaaS gross margin has become even more important as it shows a true measure of profitability. Net retention. How much do we grow with our existing customers? Talked about by many as the new North Star of B2B SaaS, and there's no doubt that it's become more important recently. A lot of companies are experiencing lower new sales growth rates, and software budgets are not as big as they once were. That means growing with our existing customers is more important than ever. Then lastly, we have customer and industry concentration. Do we have a lot of customers, and are we well diversified in terms of industries? That means we're not overly reliant on a small group of customers or a single industry, which decreases the inherent risk in our company. So those are the KPIs that are directly included in the scorecard. However, there's also a number of KPIs in the dashboard which are indirectly included through other KPIs. So here marked in blue, churn, for example, is an input in the calculation of net revenue retention, so indirectly included in our valuations. Now, the goal of the valuation scorecard is to have a simple, accurate model which allows us to quickly value B2B SaaS companies. And for that reason, the KPIs that we choose to include, they need to be readily available for most companies that we speak to. And that's the reason that CAC payback, for example, isn't included. And that's because in our experience, most companies we speak to, they don't track this KPI actively. I think the best way to explain the scorecard is actually to look a little bit closer at an example. So here we have company X. This is a company with 91% of its revenue of a recurring nature. It has an ARR of 16 million euros, 23% organic growth rate the last 12 months, a European presence, 80% SaaS gross margin, a net revenue retention of 109%, revenue the last 12 months of 15 million euros, and an EBITDA margin of 13%. So a good company, but how good and what is it worth? So if you remember back to the start of this section, we always start with the market. And in this example, the median EV sales multiple for the last 6 months for BVP Cloud is 6.4. So that's our starting point. Then we compare all the KPIs to the relevant benchmarks, which result in a markup if company X performs better than the benchmark, or a discount if it performs worse. We also look at the software market, we look at industry concentration, and we look at the number of customers. The final result is an EV sales multiple, which we then convert to an EV ARR multiple. So for company X, we get an EV ARR multiple of 4.4 and an enterprise value of 71 million euros. As you can see, this is a pretty mathematical way of valuing companies. It's also pretty simple. At least the logic is simple. The secret sauce here, it lies in the weighting of each KPI. It lies in the size of the markups and the discounts, and it lies in the benchmarks that we choose. We use this model to value potential new investments, but we also use it to value our own portfolio companies, which allows us to quickly identify where the company is strong and where the company is weak. And when using this towards our own portfolio, it also allows us to quickly figure out where we can get the most effect when working to grow our companies and increase their valuations. This is also a model which we're constantly refining to reflect any changes in the market. And a concrete example of this is in the recent shift in growth at all costs to more efficient growth. In previous versions of this model, we had the rule of 40 as a KPI input. But after this shift in the market, we decided to split this out into organic growth and EBITDA margin, which then allowed us to adjust the weighting of growth and profitability within the model. So to conclude the presentation, I thought I would share some of Viking Venture's thoughts on B2B SaaS going forward. We have experienced a pretty turbulent market the last 18 to 24 months or so, especially in B2B SaaS, where the result has been some pretty significant decreases in valuations. Now, we invest in B2B SaaS companies because we believe these companies are absolutely necessary for the future. This is an analysis from Bessemer Venture Partners, which basically concludes by saying that B2B SaaS companies, which support work processes, that's an important point, will solve the gap in global productivity. And the reason for that is population growth rates are declining, which means that less people will need to do more. That means that they'll be relying on software which supports work processes. And if we look at our portfolio today, we have companies helping solve issues with labor shortages. We have companies helping solve issues with productivity and collaboration, the creators economy, work automation, and supply chain. So sort of a last concluding thought is that B2B SaaS companies which support work processes are absolutely necessary going forward if we want to keep global productivity up. So that concludes the presentation from Viking Venture. I hope you found it insightful, and I think I was able to keep within my my allotted time. So we should have some time for any questions if there are any.
Yes, thank you very much, Martin. It was very insightful, and you touched it a bit here in the ending, but and I'm not sure you'll give your hard perspective on this, but how do you view the attractiveness of the SaaS sector in general from here? So you mentioned here some examples of the productiveness and so on, but what about, the valuations and so on? Can you give us a perspective on this, or is it just, the median look that you have based on what you told before about the index and so on?
I think what I can say about that is if you look at the sort of history, and I think if you aren't aware of the VVP Cloud Index, I think you should definitely check it out. And then if you go on their website, you can see the level of the index, and you can see that it's been outperforming sort of the S&P 500 from the very start. And I think if you look at the valuations now, we're actually at sort of historically low levels, just below historically low levels. It's sort of flattened out now and stabilized at around 6.5. But I think the fact that we're sort of at historic low levels will tell you something. And I think as well, what I said at the end of the presentation is that, these companies are going to be necessary going forward. And I think, the reason that we like SaaS so much is because the subscription model. It basically means that, we don't need to sell to the same customer every year. We get a customer on board and we know that every year we're going to sort of build up. So it's an extremely scalable model. And what I can also say is, and you can look at this how you will, but I think when we saw this sharp decrease in valuations in listed companies, that's the point where we decided to raise 2 new investment vehicles to take positions in listed companies as well as private companies, because we saw that, okay, now we're actually able to get ownership positions in really, really high quality companies for pretty low multiples. I think that sort of says our view on the market as well.
Perfect. And you also showed us some differences between the Nordic markets, and well, we have a Danish view here. At least very many of the companies today are, all of them are actually Danish listed. So do you have any explanation for why the Danish SaaS sector is valued at a higher median EV/ARR multiple than you see in the Nordics in the other countries?
I think it's difficult to sort of point to one reason. I think it's interesting to see that Norway is so low. I think there's two main reasons if we sort of start with Norway. And I think Norway is highly reliant on sort of oil and gas, big oil and gas stocks. So if investor sentiment shifts from software to oil and gas, then these software companies are gonna struggle. And I think we at Viking, we listed 4 of our companies, and all 4 of those companies were obviously very high quality companies, which were then taken off the stock exchange, which probably had something to do with the median values of those companies. And I think if you look at Denmark in particular, I think what we see is that, and obviously we've looked at all the Danish SaaS, listed SaaS companies, and what we see is there's a lot of small companies where the liquidity is almost non-existent. So you have big blocks of shares which just aren't for sale. And when you have low liquidity, then you can sort of ask some questions in terms of the valuations that those companies have. But I think what we need to see in all the Nordic countries is a bit more maturity within listed SaaS companies. We need to see some bigger companies maybe being listed. But to sort of pinpoint the reason why the Danish companies are valued a little bit higher than the other Nordic countries, I'm not quite sure. I think if we go back to the table that I have, I think actually now it's maybe Finland who has the highest the valuations, but that sort of shifts. It goes up and down, but it's difficult to point to one reason. But I think what we need in these markets is more liquidity in the shares.
Yeah. And you mentioned liquidity, and we also got a question here. So maybe you can just elaborate shortly on this, and I can also broaden the question out, because there's a question here. Can you touch a bit on the liquidity factor? You mentioned that, but as Nordic markets have many small listed companies, so in general, and maybe to broaden it out, what is your view on public versus private SaaS companies? Maybe both taking the liquidity factor into account, but also in terms of, do you see any differences in terms of reporting and how the management tracks KPIs and the professionalism of each of these companies being listed or being private?
I think it's an interesting question, because I think obviously our bread and butter is investing in private companies. And then, like I mentioned a little bit earlier, sorry if there's any background noise here. As I mentioned a little bit earlier, we took a bunch of companies listed a bunch of companies during the sort of heyday of IPOs during COVID. And what we experienced was that, the way that we work with the listed companies, it's not much different to the way that we work with the private companies. There's a bit more sort of requirements to reporting, and there's more requirements in terms of what you can and can't do. But the way that you work with the companies is essentially the same. And that's the reason that we decided, okay, maybe we should take positions in listed companies as well, because we feel like we have some value to give here. When you compare the two, I think obviously for a market to grow and for a market to become more mature, and for SaaS in the Nordics to evolve and mature, I think we need listed companies. We need sort of big established Danish, Norwegian, Swedish companies being listed, so that we can sort of see this ecosystem grow. But when we compare, I think you have really high quality private companies and you have really high quality public listed companies. Then you have some less quality private and the less quality listed companies. But I think generally, when you look at the listed companies and compare that to the private, there's a bit more professionalism maybe in the listed companies, because you have more requirements to how you work with your shareholders, how you work with the market, how you work with reporting and requirements, and generally they have a good control over the KPIs. And if you look at the annual reports for many of these companies and the companies that are presenting after me as well, they have some high quality reports where they track KPIs in a really good way, which obviously shows a bit of professionalism. And a lot of the private companies that we speak to, we've spoken to some companies where they don't have control over their ARR number on a day-to-day basis. They maybe don't track the KPIs that they should do. Doesn't mean that they're bad quality companies. It just means that there's a lot of potential to take out there. I think that's one of the main differences that we can see.